Welcome back to the deep dive. Our mission today is pretty simple, really. We're going to take the sources you've shared on strategic tax planning and just distill them into a clear roadmap. We're talking about money, of course, but more specifically, how you keep the maximum amount of the returns you've worked so hard for.
Right, because our sources made a really strong claim right up front. They basically said that choosing the right investment,
Yeah.
the market-beating stock, is maybe only half the battle.
Exactly. The other half, the part that so many people neglect, is successfully navigating the tax code.
Okay, let's unpack this. We're focusing on 6 critical tactics today. Everything from simple record keeping all the way to the strategic timing of your sales.
And that strategic focus is just so vital. This is not just about filing your taxes correctly in April.
Yeah.
It's about making tax-aware investment decisions all year long. And if you're diligent, the compounded returns on what you save they can completely change your financial future. Let's start with the one people know they should do, but, well, often don't. Meticulous record keeping, specifically what our sources call the forgotten dollars.
The reinvested dividends.
Yes.
What's fascinating here is it's how often people forget this simple thing that has such a huge long-term impact. It seems so automatic.
Right. You reinvest your dividends, you're putting money back to work, buying more shares. Seems simple.
It is. But that money is treated in 2 ways, and this is the key. First, you're usually taxed on those dividends in the year they're paid to you.
Even if you never actually see the cash, right, it just goes right back into the fund.
Exactly. And because you've already paid tax on that dividend money, when you eventually sell those shares, you shouldn't be taxed on it again.
And that is the crucial part people miss.
All the time. Let's use that example from the sources. Say you invested $5,000. Over the years, you reinvested $1,000 in dividends. Then you sell everything for $7,500.
Okay, so the easy way, the lazy way to calculate the gain is just 7,500 minus the original 5,000, leaves you with a $2,500 taxable gain.
And if you do that, you just paid tax twice on that $1,000.
So what's the correct way?
The correct way is to add that $1,000 in reinvested dividends back to your cost basis.
Ah, the cost basis. So it's what you truly paid to acquire the asset.
Yes, exactly. Your true cost basis isn't $5,000, it's $6,000.
Which means your taxable gain is only $1,500. That's a huge difference. And it prevents you from losing the future growth on those tax dollars.
Mm-hmm.
Now, tracking that seems like it could be a nightmare. Does the broker just report it correctly, or do you have to do the digging yourself?
You absolutely have to look at the paperwork, the 1099 DIV, the year-end summaries. Now, brokers should report it accurately, especially these days, but the responsibility is yours.
So verify everything.
Always.
On a related note, broker fees, commissions. I know the rules here are a little counterintuitive. You can't just write them off like a normal expense.
No, you can't. Instead, those fees also get added to the cost basis of the stock.
So it's part of the total cost of buying it.
Right. It's not a direct write-off, but it acts like one because it reduces your taxable gain when you eventually sell.
So it's another one of those little details that really adds up over time.
It really does.
We've covered tracking the money you've spent. Now let's talk about strategically managing the money you make. Here's where it gets really interesting. Let's talk about timing.
This is where things get active.
Mhm.
But the potential savings here are, they're probably the biggest of all. We're talking about tax loss harvesting.
Okay, so the basic idea is pretty simple. If you sold a winner this year and have a capital gain, you look for a loser in your portfolio that you're willing to part with.
You match them up. Capital losses can be used to offset capital gains. And there's a specific order to it. Short-term losses against short-term gains first, and so on.
But what if you have a really bad year? More losses than gains.
That's where the carryover rule is fantastic. If your losses are bigger than your gains, you can use up to $3,000 of that excess loss to offset your ordinary income.
Your salary.
Your salary, your wages.
Yeah.
And if there's still a loss left over after that, you carry it forward to future tax years. It's a gift that keeps on giving.
That is a powerful tool. But I know this strategy has a big trap. You can't just sell a stock to get the loss and then immediately buy it back, can you?
No, you cannot. This is absolutely critical. You have to know about the wash sale rule.
The wash a sale.
The IRS says it's a wash sale if you sell something for a loss and then buy the same or a substantially identical security within 30 days before or after the sale.
So that's a 61-day window you have to avoid. What happens if you mess that up?
Your loss is disallowed for tax purposes. The whole point of the rule is to stop you from claiming a tax deduction while basically still owning the same thing.
Got it. So you either wait out the 31 days or you buy something similar but not identical, maybe a different company in the same sector.
Exactly. Keep your money in the market, but respect the rule.
Okay, so if that's the hard way, maybe the simplest solution is just patience. Let's talk about the benefit of just holding on to stocks for the long term.
This is all about the tax rates.
Yeah.
And the difference is, well, it's massive.
Right. If you hold an investment for less than a year, that gain, your short-term capital gain, is taxed just like your salary.
At your ordinary income rate, which for high earners can be up to 37%.
Ouch. But if you hold that exact same asset for 1 year and 1 day,
Then it becomes a long-term capital gain. And it's taxed at the much lower capital gains rate, which is no higher than 15% for most people,
so patience is literally worth, what, 20 percentage points or more of your profit?
at least. And that savings goes right back into your portfolio to start compounding immediately. It's an incredible boost to your wealth.
Okay, let's shift from stocks for a minute and talk about bonds. A lot of people turn to them when the market is choppy for that interest income. But there are tax rules here too.
There are. First, the accrued interest rule. If you buy a bond between its interest payments, you actually pay the seller the interest that's built up so far.
Right, so you're buying the right to the next full payment.
Exactly. So when you get that payment, part of it's just getting your own money back. You still have to report the whole payment, but you get to subtract the accrued interest you paid on a separate line.
Again, record keeping is everything.
It's always everything.
And then there are municipal bonds or munis.
Yes, issued by state or local governments. And their big advantage is built right in.
Tax-exempt status.
Most of them, yes. The interest they generate doesn't even need to be claimed on your federal tax return. For anyone in a high tax bracket, these become incredibly valuable.
It's all about the math, right? A corporate
Yeah.
bond paying 5% might only give you, what, 3.25% after tax? Something like that. So if you can find a tax-exempt muni paying 4%, your actual take-home yield is much, much higher.
So for income-focused investors, that's a key strategic tool for managing your tax bill.
Absolutely essential.
All right, so we're moving from the portfolio itself now to leveraging personal circumstances. Let's talk about home sales and retirement accounts.
This is a great one for homeowners who sold their primary residence. You can seriously reduce your capital gain by adjusting your cost basis. This is where all those renovation receipts finally pay off.
So that original purchase price isn't the final number.
Not at all. Any capital improvements, things that add value or prolong the life of the home for more than a year, can be added to your cost basis.
A new roof, an updated kitchen.
Major landscaping, an addition. Keep every single receipt. It increases your cost basis, which lowers your profit, which in turn lowers the tax you owe.
And for self-employed investors or people with small businesses, don't forget operational expenses. That's right. Forgetting these is just leaving money on the table. If you travel for business, to meet clients, or check on properties, things like lodging and meals can often be written off within limits.
Okay, let's bring this all together with the ultimate tax reduction tool. The goal is often to avoid that capital gains tax every time you trade. And that is the superpower of tax-deferred programs.
This is probably the simplest and most powerful tool for most people. Tax-deferred accounts, like a traditional IRA or a 401k, they shield your investments.
You're not taxed on the money or the gains until you withdraw them.
Right. And the big assumption is that you'll be in a lower tax bracket in retirement when you're not earning a salary. So you're basically betting on a lower tax rate later.
And there's another benefit too, right? Flexibility.
Huge benefit. Since you aren't paying immediate capital gains, you can sell a stock that's run up really fast, even after just 3 months, without worrying about that high short-term tax rate.
Right.
You can rebalance your portfolio without creating a taxable event.
And with a 401k, the contributions are pre-tax, so that lowers your taxable income today.
Right. The 401k and traditional IRA are the pay later plan, which we have to contrast with the Roth IRA.
The pay now plan.
Exactly. With a Roth, you fund it with money that's already been taxed. But, and this is the huge part, it grows completely tax-free. And all of your qualified withdrawals in retirement are tax-free.
Including all those decades of compounded gains.
All of it. For a younger investor who expects to be in a much higher tax bracket later in life, the Roth is, it's just incredible.
You just have to watch the rules, the income limits and the contribution limits.
For sure. And a quick practical note on all this. Your investment custodians will send you the forms you need. The 1099 DIV for dividends, 1099's INT for interest. Use them, but double-check them.
So we've covered 6 really distinct areas, from the nitty-gritty of tracking reinvested dividends to the big picture strategy of using retirement accounts. The message seems pretty clear.
Astute tax management is not optional for a serious investor.
It really isn't.
This raises an important question, though. So many investors, they spend all this time trying to find the next market-beating stock, but they put almost no effort into minimizing taxes.
And the tax savings are a sure thing.
It's a guaranteed return.
So, since those savings translate directly into more money compounding for your future, consider this. Is the time you spend on smart tax management this year going to give you a more predictable, more certain boost to your returns than chasing some volatile stock?
I think the answer is almost certainly yes. Minimizing taxes isn't just saving costs. It's an immediate, guaranteed boost to your principal. A $5,000 tax saving is $5,000 that starts working for you today.
No stock pick can promise that. So if you are serious about this, you really should talk to a tax planner. The savings they can find for you might just provide a bigger boost to your return year after year than any single trade you ever make. Something to chew on.
That's it for this deep dive.